Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business and finance to bring you the most important stories behind the numbers. Today we've got a deep dive into Liminatus Pharma's latest SEC filings, and let me tell you, it's a story full of financial acrobatics and strategic maneuvering. Stick around as we break down what's really going on with this biotech company. Before we dive in, if you're serious about understanding what drives companies in the market, make sure you hit that subscribe button and turn on notifications. We break down these filings so you don't have to. And hey, if you want to join a community of like-minded investors and discuss these insights, join our Discord link below. And if you're serious about understanding what drives companies in the market, make sure you hit that subscribe button and turn on notifications. We break down these filings so you don't have to. And hey, if you want to join a community of like-minded investors and discuss these insights, join our Discord link below. Alright, so Liminatus Pharma, formerly known as Iris Parent Holding Corp, has just filed an amended registration statement, and frankly it reads like a financial thriller. This is a company that's been busy. They've combined a few entities and are now navigating the choppy waters of being a public company. They are developing a CD47 checkpoint inhibitor, which sounds super fancy, but essentially it's a drug designed to help the immune system fight cancer. Think of it as teaching your body's own defense system to recognize and attack cancer cells more effectively. This filing is all about registering shares of their common stock for resale by certain existing shareholders. The total number of shares involved in this offering is quite significant, around 25 million shares of common stock. This is a huge chunk of the company, and it means a lot of previously held shares are now looking to hit the market. Now, the company itself is a preclinical stage biopharmaceutical company. This means they haven't actually brought any products to market yet. They've incurred losses since they started and expect to continue doing so. This is pretty common in the biotech world, where developing a drug from scratch costs a fortune and the success rate is notoriously low. But what's interesting here is the sheer scale of shares being registered for resale. We're talking about a significant percentage of their public float, meaning a substantial portion of the shares available to the public. The company is upfront about the risks, and there are many. For starters, Liminatus is in the early stages of drug development, meaning there's a high chance their key product candidates might not even make it to market. They've incurred significant losses and expect them to continue. They also openly state that they have identified a material weakness in their internal financial controls, which could lead to inaccurate financial reporting and reduce investor confidence. This is a flashing red light for any investor to be aware of. Let's look at the number of shares. We have 27.06 million shares outstanding before this offering and potentially over 34.8 million shares outstanding after the offering, assuming all the warrants are exercised. That's a massive increase in the number of shares. The key takeaway here is that a large number of shares are becoming available for sale, and some of these were acquired at much lower prices than the current market value. This definitely adds pressure to the stock price. Speaking of stock price, as of July 2025, their common stock was trading at 6.47 cents. But here's the kicker. The exercise price for many of their warrants is 11.50 cents. That's significantly higher than the current stock price. This means warrant holders likely can't exercise their warrants right now to make a profit. The company acknowledges this state, and they may not receive any cash proceeds from warrant exercises due to the stock price and liquidity issues. This is a classic situation where the stock needs to perform exceptionally well just for the warrants to even become valuable. Diving into the financials for Liminatus, just prior to the business combination, their general and administrative expenses have increased, mainly due to costs related to the business combination itself. Research and development expenses have actually decreased, likely because they terminated certain license agreements. Interest expenses are also on the rise, reflecting increased borrowings, mostly from related parties. It paints a picture of a company heavily reliant on debt and with a long road ahead to profitability. This is where things get really interesting. Liminatus is burning through cash and has very little of it left in their operating accounts. As of March 2025, they had about $35,000 in cash. They've funded operations by selling equity and taking on debt, including significant loans from related parties like Valetudo and Prophase. The company explicitly states there's substantial doubt about their ability to continue as a going concern over the next 12 months. This means they might run out of money. Their plan involves raising more capital, but there's no guarantee they'll succeed or get it on good terms. Now, let's look at the pro forma combined balance sheet as of March 2025. This shows us what the combined company looks like after the business combination. We see cash of about $11.3 million. The accumulated deficit is a staggering $19.7 million. The accumulated deficit is a staggering $19.7 million. This tells us that even after combining, the company is still deeply in the red. Looking at the pro forma combined statement of operations for the 3 months ending March 2025, they reported a net loss of about $2.9 million. For the entire year ending December 2024, the net loss was even higher, around $8.6 million. This shows a consistent pattern of losses, which is a significant hurdle for growth and investor confidence. Scrorep enacting TED. Public accounting firm, capital accounting firm Tipus, the auditors are also raising a red flag here, stating the company's ability to continue as a going concern is in doubt due to its lack of substantive operations and insufficient cash. This echoes the company's own concerns and is a critical point for potential investors. Let's talk about who owns what. Chris Kim, the CEO and founder, and Valetudo Therapeutics LLC, which he controls, together hold about 22.8% of the shares. The sponsor, Iris Acquisition Holdings LLC, holds about 25.5%. One Comfortech and Kayach Felix Co. Limited are also significant shareholders. This concentration of ownership by few entities could limit investor interest and create pricing pressure, as the filing itself notes are limited are also significant shareholders. This concentration of ownership by a few entities could limit investor interest and create pricing pressure, as the filing itself notes are limited are also significant shareholders. This concentration of ownership by a few entities could limit investor interest and create pricing pressure, as the filing itself notes a limited public float. It's also worth noting the extensive related party transactions we see here. Loans from Felix, Valetudo, E1, Prophase, and Hana, many of which are past their maturity dates and have been extended. This reliance on related parties for funding raises questions about their financial stability and independence. For example, the loans from Prophase and Hana are quite significant, and the terms often involve interest rates and repayment schedules. Then there's the deferred underwriting fee, part of which was settled in shares, showing how they're managing their obligations. The authorized capital stock is quite large, 500 million shares of common stock and 1 million shares of preferred stock. The preferred stock has very flexible terms, which means the board can issue it to potentially dilute future acquirers, a common anti-takeover tactic. The warrants themselves are currently out of the money, meaning their exercise price is higher than the current stock price, which is a significant risk factor. We have to talk about risks, and Liminatus has a lot. They are early stage, have a limited operating history, and are dependent on continued funding. Product development is inherently risky, and they acknowledge a high rate of attrition for product candidates. Competition is fierce, with major pharmaceutical companies pushing forward with similar therapies. Intellectual property is also a concern, with the possibility of license agreements being terminated or challenged, and of course, regulatory approvals are never guaranteed. The selling security holders are essentially offloading a large number of shares. They can sell them through various methods, including ordinary brokerage transactions and block trades. They might also use hedging strategies like short selling. This is a key point. The selling security holders might be more motivated to sell their shares quickly, potentially driving down the stock price. Given that many of these shares were bought at very low prices, they can still make a profit even if the stock price dips. So what's the verdict? Liminatus Pharma is a high-risk, high-reward biotech venture. They've successfully completed a business combination, which is a step forward. But the financials tell a story of significant losses and substantial debt. The fact that they acknowledge substantial doubt about their ability to continue as a going concern is a major warning sign. While their CD47 inhibitor shows promise, especially in avoiding side effects seen in competitors, the path to market is long, expensive, and uncertain. The key number to watch is their cash burn rate versus 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 their cash on hand. With limited cash and substantial liabilities, their ability to fund future development hinges on attracting significant new investment, which may be challenging given their current listed risks. The concentration of ownership and the large number of shares being registered for resale also add downward pressure on the stock price. For anyone looking to invest, it's crucial to understand that this is highly speculative. The potential upside is there if their drug development pans out and they achieve market success, but the risks of failure, dilution, and ongoing financial struggles are very real. Alright, that's our decode of Liminatus Pharma's latest filing. What are your thoughts on these numbers and the company's direction? Will their CD47 inhibitor be a breakthrough or a bust? Let me know in the comments below. If you found this deep dive valuable, please give this video a thumbs up and subscribe to Corporate Decoder for more in-depth analysis. Also, don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you in the next one.